Hey everyone, me Kevin here. Pending home sales just turned down 2.2%, and the Wall Street Journal just ran a thorough report on the looming eviction crisis called "Struggling Rental Market Could Usher in Next American Housing Crisis." This comes as COVID cases are rising, the stock market is selling off, and all measures of fear in the economy and market are up substantially. At the same time, we face another potential threat of lockdowns, shutdowns to limit the spread of this pandemic. All while Congress goes on vacation and provides no support. So how do we puzzle the pieces of this disaster together and understand when and if this next housing crisis is coming and how bad it's going to be? Well, in this video, I'm going to go through all of the variables and I'm going to give you some projections in terms of exactly how bad I think it's going to be. First, let's talk about something known as the Housing Affordability Index. We'll keep this simple and we'll just get to the bottom lines here. When prices go up, and then this is different from stocks, so keep this in mind. When real estate prices go up, that translates to people actually having to pay more money on a monthly basis to buy that real estate. So unlike Tesla stock, real estate can't really go to the moon. It has to be affordable, and you can't buy fractional real estate, which means prices are literally bound by people's ability to pay. Very, very different from stocks, where there seems to be no upper threshold as to how high and crazy stocks can go. Unfortunately, housing affordability has started to crater, and here's why. Remember the rule of 10x. The rule of 10x says that for every 1% in interest rates, that interest rates go down, prices go up 10%. Well, that's kind of what happened. Interest rates fell about 1% and prices went up about 10%. Year over year, we're up 10, in some cases even 14%, because rates have even fallen more than 1%. And so you see this immediate kind of yin and yang with prices and interest rates. And this makes sense again because, well, real estate is tied to people's ability to afford the property they're in. So this led to a pretty nice dang frickin' boom in real estate if you were buying or you already owned real estate prior to probably August and July of this year. If you went shopping for real estate in May and June, you probably got a much better deal than you could have gotten today. And that's just the nature of the market adjusting to rates having fallen. But now that prices are higher, any benefit of lower rates is really gone for new buyers. New buyers are like, yay, I get lower interest rates. But crap, look at them prices, they're way higher. And that's a problem. And so that's where we see affordability go down. And we're starting to see, according to the National Association of Realtors, housing affordability plummet. It's at the lowest level that it's been at in the last 3 years, and that creates some problems. And this is them comparing median incomes to median home prices. So this is where generally when affordability goes down, you don't really have this exact correlation where as affordability goes down, prices guaranteed come down. Instead, what happens is prices begin to stabilize. The growth of prices gets limited. And to see this, let's go ahead and look at Redfin's data center, and we'll see exactly what I'm talking about. So this here is Redfin's data center, and what we want to look at here is we've got a chart of median home sales prices in all metros, so all counties, and this is sort of averaged out on a 4-week duration, and what we really want to watch is the 2020 data, which is going to be the red line here. And so what we could see is we've really seen prices, here you go, here's June, so I'll kind of draw June right here for us, and what you can see is this very clear increase in prices since June. It really makes it clear that the best time to buy a property was between May and June of this year. If you bought after that, again, you paid more than those prices, but we had a little bit of a sinkhole there between May and June. And so what's happened since then, because rates have stabilized low, is we got a lot of buyers coming into the market. You get real estate prices essentially going parabolic here for a moment, and then you get this incredible growth. But then you start having exactly what we would expect to happen, a flattening. See, this flattening that we're having here is really a cause of housing affordability. There's a limit, right? You get this big, massive boost because, whoa, look how cheap rates are. Oh my gosh, everything became more affordable. Prices go bup, 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 and then, ooh, well, okay, now we got these new 2% or 2.5% loans on 30-year fixed rate loans, but crap, we're hitting this ceiling. We can't get above this ceiling anymore. And that's one of the downsides of real estate. You can't expect it to go to the moon like stocks can. Now, that does not make real estate a terrible investment. Real estate's a great investment. It just makes it a different investment. It's important to know that. So really what you get is you get price stabilization. But price stabilization is just one factor here. Price stabilization does not necessarily mean prices are going to fall, right? It just means, okay, we're flattening out. We're not necessarily going to see a crash there. So instead, what we're going to focus on are rents. And there are two parts to rents to give us an idea as to what's happening in the real estate market and the housing markets. There's current rent and there's back rent. Let's go ahead and start by looking at current rent. So current rent means what percentage of tenants actually paid their rent in October? Are we seeing inflection points where we're starting to see declines in the amount of tenants paying rent? And what we can do is we can go to the National Multifamily Housing Council and pull up exactly that data. And we'll find that this data just came out a few days ago here on the 27th. And what we want to look at here is 2020. And take a look at this. 94.6% of tenants have paid their rent in October. This is actually the best reading that we have had since, well, they started doing the math here in May of 2020. It's not as good as October of 2019, but it is the best reading we have had during the entire pandemic here. It's actually a very, very good sign. It's very good to see that a higher percentage of tenants have paid rent in the month of October. Very, very good, because we want to limit the growing amount of back rent that we have from the pandemic. This brings up back rent. So back rent. Estimates of back rent are complicated and they vary widely. For example, the Philadelphia Federal Reserve Bank says that we're around $7 billion in back rent. And then you have other studies put together by universities that say, no, we're closer to $21 billion in back rent. In other words, nobody exactly knows how far behind we are in back rent, but the reality is we are behind in back rent. And back rent becomes an issue because back rent can lead to a sudden wave of tenants being evicted when evictions become possible in January. Now, some evictions are currently happening, either sneaking through loopholes or being done anyway, but most evictions are supposed to be paused until January 1st. By all estimates, 10 to 15 million households could get evicted come January, which that would affect around 40 million people. And we've previously estimated that even if a third of these properties that end up getting evicted actually finish the eviction, that gets complicated. I mean, think about it. If you have 10 million houses, just to roll with the math here, you got 10 million houses. A third get an eviction filed against them. So 3.3 million get an eviction filed against them. They're not all gonna finish the eviction process. Some of them are gonna come current, they'll borrow money, they'll figure it out, so they're not all gonna get evicted, right? And then of that 3.3 million, let's say 1/3 the landlords decide, that's it, I'm done with real estate, I'm gonna sell. Well, that'd be around, 1.1 million, maybe as high as 1.5 million if we started with the 15 million, and did a third and a third. So let's just go with around 1.5 million properties. Worst case scenario that come up on the market in the event we have 33% of evictions get completed and 10 to 15 million evictions get filed. 33% of those get completed, and then 33% of those decide to sell and hit the market because the landlords are like, that's it, I'm done. I'm done with tenants and toilets, I'm retiring. It's one of the beautiful things about owning real estate. You might not need your life insurance, which you can get in as little as 5 minutes via the link down below, and you might not need to get 3 free stocks with Webull when you deposit $100, which you can also do through Halloween night. Use those links down below, Webull and life insurance. But you could retire from your real estate, and some people might say, that's it, I ain't doing tenants and toilets anymore. Makes sense. But anyway, here's how we put the pieces of the puzzle together. Usually, we only sell, as a country, the United States, we only sell around 7 million properties per year. Well, if we take 7 million and bump that up by another 1.5 million, that's almost like a nearly 20% increase in the amount of properties that would be selling in a year. Except there's an additional problem. A lot of these evictions would happen in the first half of the year. So we're really throwing a 20% increase into the first half of the year next year, and this is where we get talks of a really oversaturated housing market potentially coming up at the beginning of 2021. My estimation would be anywhere between the second week of January and probably the last week in March. That's where we're gonna see possibly some saturation from evictions of properties coming on the market like crazy. Now that's actually scary because that is a lot of inventory. And that will absolutely have an effect of causing prices to decline. Now, fortunately, home buying appetite is huge. And so any declines in prices will at some point be met with a lot of buyers willing to buy. And see, this is where the eviction crisis could cause real problems for 2021. In my opinion, though, 2021 will look very volatile. And the easiest way to see this is just by taking out a whiteboard, a broken one at that, and then a poop-colored marker, and saying, well, what's it going to look like when poo hits the fan? Well, when poo hits the fan, we get into 2021. It's not even as good of a marker. See, it's poop-colored, and it's not even good. What kind of crap is that? I guess it's not really crap at all. This is not working. Anyway, 2021. If we go into 2021, prices have sort of leveled here going into 2021. We get an increase in inventory suddenly in the first 3 months of 2021 of 20% on a yearly basis. That's really compressing that, and that would almost feel like a 40% increase in inventory. You could see a 40% increase in inventory. Now, there are a lot of buyers who are not able to buy right now, so you're going to have buyers coming in and absorbing this quickly. But my expectation is we could easily see prices drop suddenly and for a short window of time, somewhere between 15 to 20%. Would not shock me at all. And this is worst case scenario, okay? Worst case scenario, I believe we could see home prices fall 15 to 20% in that first quarter of next year. Now, we're going to hit this threshold where all of a sudden people go, oh, these are deals. Prices haven't fallen enough to cause a foreclosure crisis. You'd really need prices to fall like 30% to start triggering a foreclosure crisis, especially since a lot of people have so much equity in their homes right now because home prices ran up. Now, it is true that people could refinance and go buy a boat and all of a sudden they don't have as much homeowner equity anymore, but most of the people getting loans right now are highly qualified. It's tough to get a loan right now. So if we get a bunch of highly qualified, basically white-collar workers coming in and swooping in and buying these deals at possibly, let's call it a 10 to 20% discount, if we saw this sort of flood of inventory hit the market next year, 10 to 20%, that sounds realistic. We're probably going to see that be a very short-term impact. And it wouldn't surprise me if come the summer of next year, we start seeing those prices tick up again. So we could actually see this V in the real estate market as basically evicted properties come on the market, landlords dump those properties, they come into the market at a concentrated period of time. We see home prices fall 10 to 20% for a short period of time, so get your cash ready, so to speak. Then we see prices lift up probably to where they were, or I would say within 5 to 10% of where they were. So there could be this sort of lingering negative 5% that we see, 5 to 10% of where they are. And then I would expect us to sort of continue on this more range-bound trajectory. That is, I think we'll see much lower real estate appreciation throughout the rest of the decade, unless interest rates trended even lower. Because remember the rule of 10x, interest rates trend lower, then prices go up, right? But right now, we're just really bound by that affordability curve we saw at the Redfin Data Center. So either way we slice it, and I want to be very clear, these percentages are estimations, right? There's no way for us to exactly predict what's going to happen. But it makes sense that even if we take out all of the percentages, that we could very well possibly see a V-shaped dip at the beginning of 2021. This means, folks, you want to get educated in buying real estate. And yeah, I happen to sell a real estate investing course linked down below. But look, I'm a real estate investor too, and don't take my deals. Go shopping somewhere else, okay? So let's talk a little bit more about what we actually expect this to mean, because there are also some dangers, because we have, well, 2 asterisks that could make this V not come or make it worse. So what could make the V worse, or what could make it better? Well, there are 2 asterisks. Number 1, Congress. If Congress finally gets their act together and provides rental relief, that V might not happen. Like, we could literally, instead of seeing this V happen, we could just literally see, there we go, weak. We could literally just see the market kind of continuing across and bridge. In other words, Congress doing rental relief, 20, 30, $40 billion worth of rental relief, which is very likely in the event of, let's say, a Democratic sweep. It's very likely that we'll see this. And I like to say that if Republicans win as well, that we will see rental relief. I do believe Congress will act. If Congress acts, this V may not happen. This V only works if Congress does not act to bail out tenants. The only other thing that could possibly create a crash in real estate, and something that would be more long-lasting and potentially more damaging, would be if interest rates go up. And the reality is we are going to see inflation, which is related to interest rates. Remember this. Think about this, okay? If inflation goes up, the Federal Reserve likes to increase interest rates to combat inflation and bring it back down. They want inflation to be around 2%. If it goes up too high, they'll raise rates to bring it down. But right now, we have zero indicators that we're actually going to see any meaningful inflation. We're going to see a spike in inflation in March and April, but that will be temporary. I'll make a separate video on that. In fact, with a lack of stimulus, the reality is worries of inflation have faded even more, and right now we're seeing more indicators of disinflation, aka inflation falling, than inflation going up. So the Federal Reserve has also promised to maintain a, quote, accommodative stance until we are, quote, well into an economic recovery. And this means the Fed is unlikely to doink with interest rates and raise rates until 2024 to 2025. So, aka we have a ways to go. Now, it's crazy how far we have to go. I mean, 4 to 5 years, basically. I mean, the earliest any Federal Reserve banker thinks rates are going to go up is like late 2023. If anything, rates are probably going to just continue trending low. But the bottom line here is this. For 2021, we've got a situation where if Congress bails out tenants with stimulus and rental relief, we probably won't see a crash at the beginning of 2021. If Congress does not bail out tenants, we could see prices net down 5 to 10% over the year with a sharper crash at the beginning of the year. And even if you disagree with my numbers, I think we can all agree that we'll see a V, because of a sort of a temporary dip in real estate prices because of an eviction crisis. However, as low rates continue to prop up demand, we'll likely have a floor, and therefore we'll see these prices sort of return. And I wouldn't be surprised if we ended 2021 pretty much flat in real estate. We'd really have to go far to see a foreclosure crisis. Prices would have to fall 20 to 30%, which depending on how many people get evicted, it depends. But here's the thing. Look at the October rent data. It's improving. People are catching up. People don't want to get evicted. And if people are catching up and people don't want to get evicted, then this actually minimizes the size of our V. And since rates are staying stable, at least at the moment, then housing crash might actually be very avoidable even if we have an eviction crisis. We will see a V though. So if you're thinking about getting into the real estate market or you're looking for an opportunity to shop, maybe early 2021 might be an opportunity, unless Democrats sweep everything in the election. And in such a case, we probably would see some kind of rental relief more likely. And I do believe that Congress is going to come in to, no matter, even if the Senate maintains its Republican status, even if Republicans swept everything, I imagine we're going to see renter relief. Treasury Secretary Mnuchin has mentioned that many times, that he's a proponent of renter relief. So right now they're just casually under an extended deadline through the end of the year. So those are my thoughts on a real estate crisis. None of this is anxiety-inducing enough for me to suggest that I want to sell. I'm willing to ride out with the investments that I have any kind of V-shaped crash that we might see at the beginning of next year, because I think it'd be more of an opportunity for me to just add a few properties if this happens, especially in multifamily. I think multifamily might be a little bit more adversely impacted by this. We'll see, though. That's my insight for the real estate market and the potential for a 2021 real estate V-shaped crash. Thank you so much for watching. If you've appreciated this, please consider sharing it. Check me out on Instagram, and make sure to get your life insurance and your 3 free stocks via the links down below. Thank you so much for watching, and we'll see you next time.